So hey guys, I do apologize for being absent. I haven't put out a video in a long time. Even on Instagram, I have been absent too. Well, I did tell you guys I was going to be away from the second week of December and I wasn't going to be back to the second week of January, but at least I was expecting I'll be able to put out some content. But I wasn't able to because I had to go back home. My holiday was cut short. I had some other things I needed to handle, which are personal things. But now that I'm back, and to make up for it, I'm going to give you guys an insight of a Q&A that I had with my mentees. I think it was sometime last year. I can't remember the month exactly. I think it was the month of July. So I had a Q&A with my mentees where they had to send in a bunch of questions and I broke down everything, did my possible best to answer the questions, and then reiterated and then send it back to them. So you guys are going to have a sneak peek, or rather, you guys are going to have a full out view of what the Q&A question session, whatever you want to call it, was like, and yeah, you get to see what happens in the trade room. But either ways, I wish you all a happy new year and everything is going to kick back to being normal. I'm back at home, back at my workstation, and I hope you guys have a wonderful trading week. And yeah, enjoy. Alright guys, so this is the video for the Q&A that you people sent in, and I'll be going over the questions that you guys asked, and yeah, I'll be starting off with okay, you know what, I'm not going to read out the names, so just watch the video and you would know what question they asked me, and I think it's better that way. Bloody birds. I think it's better that way. The first question I got was, what is a first trouble area? So I'll show a live example of what is the first trouble area and how I define first trouble areas. This is the hourly chart of Euro USD. Now, a first trouble area basically means an area of trouble. This is basically what the name defines, an area of trouble. Now, let's say you've gone short on a trade and you're expecting mm, let's say probably 150 pips target, right? That's where your ideal target would be. That's where you want to see price run to for 150 pips. Now, what happens is that when price is meant to run for 150 pips, there are areas of resistance, right? Now, I'm not talking about support resistance, I'm just talking an area of roadblock resistance where price will find it hard getting past those levels. And it's always good to defend those first trouble areas or second trouble area, third trouble area, depending on how many you find while you're in the trade, because that helps you be active on price and let you understand if price is more likely to move in your direction or how further down is going to keep moving in your direction. I always say the thing that helps me determine if I'm going to stay in the trade or not is one. First thing is where price is currently at. What are the chances that price is going to keep on moving my way? That's the first thing I do. What are the chances that price is going to keep on moving my way? Now let me give an example, right? You see this trade right here where price takes out, breaks market structure here. So here we got our breaking market structure, and then price pulls back to this order block here. So let's say you go short when price pulls back into this order block. You've gone short now and price has pulled back into this order block. Now your ideal target for this is the previous weekly low. We have a breaker here. If I go down to the lower time frame, you see that that's a breaker. So we have a breaker here. All right, so here we have a breaker. So we have a breaker here, have a previous weekly low. We have a nice order block here. If I go back to the R, you can see this is a nice order block here. And then this is the intermediate low of the week. So here is Monday's low. Here is Monday's low. Here's the order block. Here's a 30-minute breaker. Here's the previous weekly low. Now, on this trade, I took this trade live. And when I took this trade, I went in using the 5-minute breaker, which you can see here, where price sends price up, runs and stops on this level, and then pushes below this breaker, a re-entry at the low of this breaker. This is my entry here. Now, if I put on a risk reward in this, let's zoom out on price. So mind you, this is going to be our first trouble area, second trouble area, third trouble area, and then final objective was the previous weekly low. Now, if this is how I judge my trades, if the final objective, which is the previous weekly low, is about 26R, if I get the next thing closest to my final objective, which is 16R, is that a bad trade? For me, that's not. That's me done for my weekly objective. Getting a 15R, 10R is my weekly objective. So you can see that each and every one of these points where price gets to, price reacts off of those levels. Why? Because those levels are important. This was the intermediate monthly, intermediate weekly low. Price got there and did a pullback. Now, when I was trading this live, what I do is that when price gets to a first trouble area, right, and starts reversing on me. Now you have to understand that in as much as I know how to call the market, nothing is guaranteed. So when price gets to key levels and I start seeing a pullback that I do not want to see, what I do is that depending on how far the trade is running, I would either cut my trade short by maybe shaving half of the lot size, or I would break even my trade. Now, in this scenario here, where price started pulling back, at this point, I broke even my trade here, and I said I was going to hold the rest. And depending is either was going to come and take me out of break even, or price keep on pushing my way. But in this case here, price pulled back and then pushed on to the next key level, where I expected the next level of resistance, pull back again, and then pushed on again to the next level. So at this key level, now basically what a first trouble area does for you is that it helps you get ready for if your trade idea is wrong. So you either have the option of shaving off a lot size, or collapsing your trade fully, or pushing your trade to a break even, basically just making your trade safe. So that's what I use the first trouble area for, a second trouble area for. Basically, that's what I use trouble areas for. I just call them TA. Obviously, TA can equally mean technical analysis, but I define TA as trouble areas for when I have an open trade running. So that's how I define a trouble area. Now, second question is where to find significant order blocks during a ranging market. The thing you have to first find out in a ranging market is where is the range high and where is the range low. Take all of this off. And now for a ranging market, the first thing you want to do is where's the range high, where's the range low. That is the first thing you want to be concerned about. Now, if we're looking at the euro before we had the big fall. In this case, this was a range high, and this here was a range low. Now, the order blocks that are important in a range are usually at the premium or discount part of the range. Now, what am I saying discount or premium part of the range? If I pull a fib, marking out the high and low of this range, making this a EQ of the range. So anything above is premium, anything below is discount. Now, what happens in a range is that the cleaner PA, the cleaner setups, would most likely happen at the premium out at the discount of the range. More times, the 50% of the range is where prices accumulate. This is where the prices are determined if it's going to be swung higher or swung lower. You can see how we have a stab, break below, break above, price retesting the EQ, pushes below, breaks above. See how when price happens around the EQ of the range, is usually just consolidating or accumulating to swing towards one side of the range. And you can see before we had the big push down, it came from the accumulation at the EQ of this range. Now, if you were trading this here was a good order block to use. And if I switch up to the 4R, because I know I took a trade somewhere around here, if I switch up to the 4R, this right here was a good order block to use. Minutes. This one. Yeah. Which was above the EQ of the range. So more times how I define a range is that if I see stuff lining up at the EQ up above the EQ of the range, I want to be a seller there. Like in this case here where we just kept on pushing as soon as we took out this high, we came back to take out this low. Anything that sets up above, I slightly want to be a seller, and anything that sets up below, I want to be a buyer, depending on like the higher time frame structure that it's showing to me. So that's just how I discern order blocks when I'm trading a range. And Once you break out of the range, it's obvious you broke out of the range here, and then from there we'll be seeing lower prices. That's basically how I trade a range. Another example of a range here is this. Now, if you can notice, price was trading within this range. It's probably about 100 pip range. Put on a fib from this high, this low. This is the EQ of the range. Go down to the lower time frame, which is probably the hourly. Yeah. So if you go down to the hourly, when stuffs were happening below, I want it to be a buy. You can see that every time we get to this low, price rejects off of it, gets back to this low, price rejects off of it. Now, an example of finding a breaker here was this one right here. If I go down to the 15-minute, I took this trade live. This candle ran down, took out the low of this range, and breaker play, price pushes up. This is why I TP'd my trade. And what did I say about the EQ of a range? You can see that once you get here, price starts accumulating, shit to bed, price accumulates, price this. More times there will be an accumulation at the EQ of the range. You can see this accumulation pushes up. This is the only clean breakthrough we have here and here. And you can see when we get a clean breakthrough, price will go to the other side of the range. Clean breakthrough, we didn't get the successful push, accumulated, pushed up, accumulated, pushed below. Accumulation is always at the EQ of the range. Accumulation distributes lower, pushes back above, accumulates a bit above in this area, then pushes for the higher of the range, then finally breaks below the range and then makes lower prices. So that is how I treat finding other blocks during a ranging market. The first thing you even have to understand is where is the ranging market, where's the range high, where's the range low, where is the equilibrium of this range that you're dealing with. That's how I treat the ranging market and find other blocks or breakers within the ranging market. The next question is how to discern. Oh, fuck's sake. Don't tell me I didn't turn on my mic. So, guys, this was quite annoying that I did the first video and I did not have my mic turned on right now, and I did a cross check like 4 times just to make sure that I had my mic turned on. But I did the video in two halves, which is basically the first one, and then the second one, that's the second one I didn't have my mic turned on. So let's just get to it. Okay. How to discern when a range is going to how how to discern as to when the range is going to end and transition to trending markets. Does this have to do with change of seasons? Because you say we're in summer season right now. Yes, it definitely has to do with change of seasons. You have to understand that the market works with something I call time and price theory, which basically means time determines whatever price is going to do 9 out of 10 times. Yeah, that sounds like a rhyme. Time and times. Anyways, time determines what price is going to do 9 out of 10 times. So if you look at it this way, why do we not trade by 12 midnight? It's because the time is not favorable for price and because people are not in the market. So yes, the market has a spirits like the towards the second half of December, probably from the second week of December, the market goes dead. You don't really get much. You don't really get nice moves again. You might find one or two. That's the thing. You know, as if you will not get any move whatsoever, but the moves are not really so clear again up until the second week of January. So once it gets to the second week of December, third week of December, I go on a break and do not trade again until the second week of January. That's when I come back and I'm very active. And then the market moves really nice to in the start of the year, probably from late January to early March. That's when we get the really fluid move. So the first quarter of the year is really, really beautiful, and the last quarter of the year is really, really nice. For some reason, I don't really know why that happens, but that's how it works. The last quarter of the year, price moves really good. Talking about from towards late August leading into September leading into October period, price will move really, really nice, and that's when you see the nice trends. I'm talking about the start of the year, you will go check on price. We're having daily ranges on cable for 200 and something pips, as if it was nothing. Like London Open cable has done 180 pips and then expands into the New York Open and then finally ends on like 200 something pips. The only one, I don't know if to call it a swing trade. The only one big trade I took this year was GBP shorts, and I can send you guys a document on that if you want me to. You know what? I'll send a document. I'll just drop a document with this. GBP shorts, and it was something really basic, strictly going short off of an hourly order block, and it did 500 pips in a day. I think. I think 600 pips in 2 days. So during the start of the year, price moves really nice. That's one thing. So yes, it has to do with seasons. So during the summer period, obviously summer is when people go on breaks, people try and have a vacation with their families. December, people try and take vacations with the family because of the Christmas leading to New Year. So this period, price moves a bit choppy. It will range for most of the time. It's strictly a market for scalpers, people that will go, people that can precisely pick out 20, 30% from the market. These are the kind of markets that favor those people. Summer markets are kind of markets that favor those kind of people. Um, Basically, how to know when price is about to leave a range. I just explained that in the last question where I was answering your question about a range and when price breaks out of a range and how to know when to discern range high, range low, the equilibrium of the range. Discerning the EQ of the range is very, very important. It helps you, it lets you know when the market is about to accumulate and to know if the market makers are about to swing prices to discount areas or to premium areas. That's very, very important. So I hope I've answered that question. Now going on to the next question. How does the Asian session affect targets during the rest of the trading day? I must say trading bias or maybe trading targets if you get the thoughts. Yes. Now the agent session, right? The agent session is I use the agent session to determine my targets, which is basically, let's say, if that, let me just give the foundation of the agent session. The agent session for me is the accumulation of the day. It's like the pivot of the day. Now, this is going to be based off of the pairs that I trade because I trade mostly Euro USD and GBP USD because those pairs are not active during the Asian session. So that's when people accumulate their orders. That's when the decision is made on where the market is going to swing to. That's what you use to determine the pivot of the day. That's what is used to determine where the market is going to go to. But if you're trading pairs like USD JPY, AD USD, NZD USD, GBP JPY, basically JPY crosses, Aussie crosses, Kiwi crosses, right, which is New Zealand crosses, those pairs move during the Asian session. So I can't really say the same for them. So you might get active sessions where they do 100 pips during the Asian session for those pairs. But for pairs like Euro dollar and pound dollar, the Asian session is used as an accumulation of the day. Now, let me give an example where it's used as an accumulation of the day. If I apply this and 15 minutes, it's about to rain again. I don't know why it's raining all throughout this whole week. Um, you will notice that there are small ranges on each of these agent sessions. This top dash and this lower dash delineates the agent session. So you can see where it accumulates, then expands. Once price leaves that range, because the agent session for me, right, agent session starts from midnight to 5 in the morning, sometimes to 5:30 in the morning. And what happens is that when price breaks out of that after 5 a.m., that's what determines the daily range. Sometimes you get a swing below the agent session taking out stops and then price swinging the other way, which is basically the accumulation, the manipulation, and then the distribution of the price of the daily profile. Or sometimes price will basically break out of it and then trend in the direction that it broke out of. Now, for instance, look at this, right? Price consolidated, right? Price is consolidated throughout the Asian session. When it breaks out of it, this is a manipulation of the day. Where does it manipulate to? I think this right here, which this level here is an hourly order block. If you can remember from the previous week what I was saying, this is going to be the low of the day. These are the kind of things that makes me understand when the low of the day is being formed. For I think Robin asked me how did I know. Some simple things like understanding that the Asian session has accumulated. We have had a void fill. Price manipulates out of the Asian session, runs into the key level, which is the hourly order block, and then the distribution for the day happens. And then where would I have used as my ideal target? Using the Asian session highs or using 10 pips above the Asian session highs. Now let's add 10 pips to the Asian session highs right here. Hope I got that right. All right. So if you go for 10 pips above the Asian session highs, here it is. So this would have been your first target, your extended target for the day. This is how you determine targets when you're trading using the Asian session as for target requirements, as basically understanding what the Asian session does. So I hope this answers the question. If I go back in time, I can show another scenario where the Asian session accumulates, then manipulates and distributes for the rest of the day. I think it was yeah, here, right here. So if I zoom in on this, you can see the Asian session accumulates, then it manipulates and takes out the previous daily low. Manipulates and takes out the previous daily low. As soon as it does that, it starts expanding higher. Then it found a breaker to find support, then expanded higher to took out the weekly highs before ECB happened. So yes, the Asian session, that's how I look at it when I'm trading euro dollar and pound dollar. I look at it as accumulation of the day. Let me see how it affects targets. Okay, I've answered how it affects targets and how you can use it to get targets off of your trade. This is an example how to use it to get targets. The trading bias. Yes, it could help for trading bias in the sense of if you understand how accumulation, manipulation, and distribution works, it can help for a trading bias in the sense that, all right, if we have accumulated during the Asian session range and we have run up to a certain level, like use this for instance, we accumulated during the Asian session range right here. This was the accumulation from towards the end of the day into the Asian session range. As soon as we broke out, when price pulled back into the range, we're taking out the Asian session highs. We were able to find selling here using this as a breaker. Look at it closer. This was the kind that activated it. I took a trade on this day. We're able to find selling here and then price distributes lower. Now you could have targeted this low or 10 pips below this low or this low right here, but I was going for the previous weekly low. But yes, that's how I use the Asian session. You can see again the accumulation, price returns back to an order block that was being formed during the Asian session. Then we make higher prices. Um, I think I've answered that. Someone said when looking at the DXY to confirm your trade ideas on Fiber, for example, what exactly are you looking for? Like yesterday, you mentioned Euro tapped into an order block and DXY did not. Now, what exactly am I looking for when I look at the DXY to confirm my trade ideas on Fiber, for example? Now, first thing I have to say is the DXY on Fiber is correlated quite a lot, but you have to understand it is not 100% correlated. It's not 110% correlated. It's more about 94, 96, 97. I can't remember the figure, but is in 90 something, probably above. I'm thinking it should be above 93% correlated with the DXY. So DXY and Fiber are that strongly correlated. So you have to understand that in as much as the DXY is a leading indicator for Fiber, right? That extra 6, 7, 5%, Fiber can make a decision on its own. Now, how do I know every time when Fiverr is going to make a decision? I don't know every time. This is why I always say trading takes some time to learn because you have to see it happen. You have to understand why it happened and certain things. And there's how when you trade for a long time, anyone can attest to this. Let me see who's been trading for a long time in the trade room. Peter, Prayesh, Courtney, Troy. At least those are the ones that I know that they told me they've been trading for a long time, and I've spoken to them. I know how they trade. There are certain things that you cannot really teach someone. It's a gut feeling and it comes from experience and then it comes from the time that you've put into charts. There are certain trades that I would take. And if you ask me why, no matter how much I try to explain that trade to you, it might not make sense to you. Reason why is because that came from a gut feeling, that came from an experience, that came from me putting in time and seeing certain things happen over and over again, and I trust myself enough to take that trade, regardless of how no other person will take the trade. Like if when you're watching the weekly recap that I did, there's a trade I took on Wednesday, and no single person in the trade room, nobody took a trade on Wednesday. And if they took a trade on Wednesday, they didn't take it off of the breaker that I took it from. Now you might ask me, well, that breaker doesn't make sense. You might not make sense to you, but it made sense to me because that came from experience. I've seen it happen over and over again, and it's a gut feeling. I trusted it because I mean, like, I don't know how to explain gut feelings more than that. But any other person that's been training for time can attest to this. Now, what am I looking for exactly in DXY to confirm my move?
I use the DXY as a leading indicator. You have to understand that there are two kinds of indicators: lagging and leading indicators. Now, most the DXY is not, in case you're new, it's not something I apply to the chart. Like, when you come up here and you click on this and then you apply an indicator. That is not the fuck. I just got debited. I don't even know why. I'll check that after. Um, that's not what I mean by the DXY indicator. The DXY is a price chart on its own. Now, what I look for is I wait for the DXY to show me its hand, and once it does, I use that to frame my idea on fiber. Now, for instance, there's a trade I took on Wednesday, is it? Let me just use Wednesday for an example, right? Um, I went long off of this breaker right here. So 5 minutes. No. Sorry. So I went long from I went long from here, right? So this was the breaker that I used. See this breaker right here? The price came down, took out these lows. No one took this trade on this day. Took out these lows. I went, or at least for the people that said anything. Let me not try and sound like no one really did. I don't know. For no one really said anything about the trade on Wednesday, so I'm guessing no one did. But if you did, well done to you. Anyways, I went long from here. We got the close above with this candle. When this one shifted back in, this is when I went long, and this happened. But guess what? I got out here. Now, I got out at this point here. I had two positions running. One of them I got out here, the other one I left at the break even just in case it expands higher. But why did I even collapse a position here? Now, and if you look to the left side of the chart, there was a double top. So this is actually what I was going for. This is actually what I was going for. But why did I collapse my trade here before price got to this point? Now, if I put up the dollar charts, which I will right now, if I put up the dollar chart last week, we had this. This is the reason why I got out. And if you watch the weekly recap, you see me fully explain why I got out at this level. But I'll just give a quick summary. I'm not going to go into full details. When I took that long, this was expanding, and as soon as this tapped into the 4-hour bullish order block, I collapsed my previous position I collapsed my position on euro. And now, if you look at euro, there was no 4-hour order block on euro. You can see here it was clean highs that I should have probably held for. But why did I get out here? And I was right about getting out there is because I used the structure on the dollar. So basically what I do is I use the structure on the dollar to tell me what to do on euro, especially when I'm in trades. I use it for like take profit levels, scaling out of a trade, when to enter a trade. Sometimes this is what I do for in the dollar. So I did this and I got out here, and I'm happy I did, because when I got out at that point, price fully reversed and came into the hourly order block before going back down again. At that point I was fully flat on the trade. Now there are times where euro will set up and the dollar did not set up. Now let me give you an example again. If we look at euro, I think it was here. This was last week. Yeah, must have been, yeah, it was here. So if I go down to the 15 minutes chart here, all right, so this is it. Now, and you see this move on here on euro where we get the stop run on price and and then we get the breaker play. This is what qualified the breaker play here. Let me zoom in. When this candle closed below it, the retest of this candle, when this candle closed below it, when the next bullish candle got in, this is when I sold, and prices distributes lower, right? Now, if you look at this day on euro, it did not look anything like this in any shape or form. There was no setup like this on the dollar. Sorry, my bad, on the dollar. So this is the 10th of July. So let's go to the dollar and look for the 10th of July. Okay. So here it is, 10th of July. If you look in, there was no stop run on the dollar to qualify to guarantee the move. There was no breaker play on the dollar. It just expanded high and then expanded again. So expanded accumulation, expansion again. But why did I take this trade? It was simply just a gut feeling, trusting the charts, understanding that this fractal play was necessary. If you watch one of my daily recaps, I fully explain why I took this trade. We had a 4-hour order block here, took out the previous weekly high, had a void, had a 4-hour level that we're about to run into. I'm not going to go into full details of this whole trade and start breaking it down now, but these are some of the reasons when it doesn't line up, and I'll take a trade regardless. So for the question that I asked where you said Euro tapped into an order block with DXY did not, it's probably one of those cases where everything had lined up perfectly on Euro, and I just went in and like, you know what? Yeah, I've done my homework and this should work. You can see this, the price takes out the previous weekly high, the 4-hour order block retest. There was, I think, another breakdown on the hourly. Then finally we get the 5-minute breakup play. We'll have this, and I just went in because everything lined up just except the DXY. So you have to understand that you can't always have a 10/10 checklist. You can, but you will miss out on a lot of things because trading is about adapting to when it's what if it's 9.5/10. What are you going to do? The only thing that I have that is a 10/10 for me that I do not break the rule no matter what happens is is me taking trades from anything that is not a lower time frame breakup. I will never ever do that if it's not a lower time frame breakup. Next question is, except I'm swing trading, which I hardly do now, but if I'm swing trading, yeah, I could take a swing trade. Um, the next question is um, when looking, no, how do you go about your top down? Oh, so sad reading this again because I answered this question so perfectly last time. I don't know if I'm going to be able to deliver it that way. All right. When looking at the DXY, no, how do you go about top down analysis on Sunday night with confluence from DXY for the week? You don't have to do in depth, but a summary would be nice. Now, I do not do my, I hardly do my analysis on like Saturdays or whatever. I do my analysis after the after the what's it called? After the agent session on Monday, which is basically from 10 p.m. I let 10 p.m. Sunday to 5 a.m. in the morning Monday play out before I even check to do my analysis. Why do I do this? It makes my bias much more correct. And if you are a day trader, as I am, or short-term trader, you only need so much to confirm if you're going to open a trade or not. Now, back then, when I used to do more of swing trading and short-term trading, yes, I used to do more of swing trading back then. When I used to do more of swing trading and short-term trading, I would do my analysis from the monthly, go down to the weekly, go down to the daily, find my levels, know what I'm looking out for, and then simply wait for price to come to my level and tap into a trade. Um, I'll try and see if I can find one. It was like analysis, 2 trades that I did last year on Gbpcad and Gbpaud. Yes, I can still remember all the trades I've, well, not necessarily all, but 9 out of 10 of the trades I've taken in my life. I can remember most of them. Necessary. I'm not going to answer that because you asked. We're using the DXY as a confluence. The other trades I didn't use the DXY as a confluence. But now using euro dollar, let me just show an example of a swing trade. I think I approached this from a swing trade basis. All right. If I go back to before we broke out of this range here, when this happened, right, when we swung for higher prices, let me see what's here. No, it's the other one. When we swung for higher prices, took out this low, sorry, took out this high here. Swung for higher prices, took out this high, and price did this. Let me see. The weekly close was, all right, so yeah, this was a weekly close here. This candle right here. Now at the same time on the dollar, we were having this. Coming, trying to remember. No, I did the top down analysis on this move before we shifted higher. Okay, yep. Now this is what I was expecting on the dollar. Now, and if you look at the dollar, we had this range here. Let me just mark this out with a big box. we had this range here where we were trend consolidating in, and then finally we break out of the range here. So when we broke out of this range, what I was expecting was for price to drop to this level, right? I expected price to drop down to this level, but guess what? That didn't happen. Only we tested the half the range. But then on euro, I got my what's it called? I do this. So now when we broke out, I wanted to see price drop back into this. That did not happen. So I used this for an example. Now here's an order block that formed on the higher time frame level. Then we had the breaking structure here. So I used both of them. I called this on my Instagram. Check on my Instagram post, you see it. So when price tested back into this order block here, price tested back into this order block here. That's when I went short on euro. I didn't swing trade this, so I'm not gonna bluff. I didn't swing trade this. I think I collapsed the trade on this day when we tapped into this area here. Yeah, I collapsed it when we drove into this breaker here. That's when I collapsed the trade from here to here. It wasn't too much of a big trade, but those are kind of things I look for. I hardly do analysis on Saturdays or Sundays because I'm a day trader. But if you want to do your analysis and using the dollar as a confluence, using the euro as a confluence, go from the monthly, go down to the weekly. Let me give you a quick example of how you would have swung trade cable for 1,000 pips. Now using the what's it called? Using the idea of understanding how a range works. As you can see, we had the what's it called? The trying to remember the name. The monthly candle for January, and then we had the monthly lows for January here. Now this would have been your simple range for price. In as much as we had a smaller range in here, this was the bigger range. So as soon as we took out this range high here, now to go to the daily chart, zoom out and look at price. When we took out the monthly highs here, sorry. All right. Now, when we took out the monthly highs here, the next thing that I was looking for was a breaker play. And breaker play would have been when price drops back down to this level. I wanted to see a breaker play from here, and then for the prices, like for the lower prices. So how I did my analysis during the weekend before this happened. I think this was Monday and this was Tuesday. Hold on, this was Monday. Yeah. So this was Monday right here. Now what I was anticipating was an SMT divergence. If we look at the euro dollar, if we look at the dollar index, it were making higher lows, lower highs. I'm always making a mistake with this. Anyways, we're making higher prices, but then the British pound was seeking higher prices here. Now, if the euro is going high, if the dollar is going higher, pound should be making lower prices. But the pound was refusing to make lower prices. I just told myself, if we take out the weekly high right here and pull back into this range, I would want to see an expansion coming down because there was a double bottom here, coming down for this double bottom right here, and then all the way back down here. Now, you if you're doing your analysis during the week, you have to understand that your analysis might not play out word for word. So you need to have a bigger framework. Cool. This is what I want to see. But if that doesn't happen, does that still validate your trade idea? Because what I was expecting more of was a week above on Monday and then a push back into this. But then we got the week above on Monday, got a further push on Tuesday, and that's when I sold. No, I did not swing trade this again. I basically just had the high time frame targets and then I was scaling in and scaling out of the trade. Like this was an example of a position that I took. Here we had the hourly breaker. Price ran up, took out this highs. A retest of that breaker. I went short, collapsed my first position when we took out this lows here with the news. I didn't take no position again for the week. All of this happened. I didn't get any positions again. Then going further into the week, I used the breaker play. Last down candle before we get the stops taken out, break below it, a retest of that. That's when I went short again. I had another extra position on here. Then this happened. I took a position on Friday, called this trade out live. I think it's called Carnage on my Instagram. And then we got the further push down on price. So that's basically just what I look for in, should I say, weekend analysis. I just go top down analysis, monthly, weekly, daily, then I scale on my trade. If this doesn't make sense to you, if you watch most of my weekly reviews on my YouTube, I fully explain how I do my top down analysis. I can't remember what trade that was, but I fully explain how I do my top down analysis. So probably you should watch that if this doesn't answer your question, because in as much as I'm a lower time frame trader, 5 minute, 15 minutes, I always do higher time frame analysis from monthly, weekly, daily. During my daily reviews, I explain how I got to that point. During my YouTube free content, I explain what made me go short on a trade or go long on a trade. So that's that. And moving on to the next question, being able to discern proper order blocks and breakers. I've answered this question more than 10 times. It gets kind of tiring answering the same thing over and over again. But okay, being able to discern proper order blocks and breakers. I always say that an order block, and I had a knock on the door, so I had to go answer that. Being able to discern proper order blocks and breakers. This is probably the most tiring question to answer. Um, an order block is simply not just the last down candle for an up move or the last up candle before a down move. A series of things that makes an order block significant. First of all, where is it placed? What significant level is it at? Is it at a 50, 20, 80, 0 level? What is structured around that order block? Is there a void leading to that order block that would make it more probable to work? Is there is it at a discount level? Is the bullish order block at a discount level? Is a bearish order block at a premium level? Did it break out of a consolidation? Did you have the order block form after or before a void happened, like what we got on Euro last week, like a situation like this? When I see order blocks like this form, I take it quite important. Let's see. When I see things like this one, where I have the last down candle, then a clean move up and no retest of that down candle, I will take it quite important because this is a fresh order block. And then if you look at this again, where was this order block formed at? If we zoom out on price and we use the previous weekly range, which was this high to this low, if you remember what I talk about price accumulating and keying off of EQ levels to basically shift to premium or discount levels, this was around an EQ level, which was basically at 1.16599. If you make it 1.1660, that is a round number, zero level. So those are the kind of things I take important of how to discern proper order blocks. Again, here's an untested order block where we have a fresh order block. Price runs up, no retest, we get a breaking structure, no retest of that level, price comes down to it, keys off of it before coming back down. Now, yes, it still came back to violated, but even this move up was about 60 pips. If we look at the GBP USD, though I haven't been trading it, I've been following it. Where did this, I think it was this one here, where did this move come from? If I simply do this, you would have a bit of an aha moment. You can see this is an order block. These are the kind of orders that I personally like dealing with. And where is this order block? You can see this is a fresh order block, hasn't been used. This basically drove the pivot move up, broke structure, price faded it before moving high, and then finally get a retest of it. That's why price keyed off of it so nicely. And you see how many pips this is. 200 or something pips. So basically, order blocks come from what level is it at, what structure is it framed around, um, how many times has it been used. That's important for me. I do not really like using breakers that have been used like 6 times. It's kind of makes me feel like that level is weak and it might break through it. It's just is a personal thing that I've noticed from my trades. So I mostly like using breakers that have been tested. I like seeing price kill for my breaker at most 3 times, like 1, 2, 3. There, just need to leave that area, even though I'll get iffy and I might shut down the trade. Or if I'm looking to enter off of, let's say, higher time frame order block or higher time frame breaker or breaker, I like seeing the breaker that hasn't been used before. So the first touch of that breaker, I want to see price leave the zone quickly. So those are the kind of things I look out for: fresh demand areas, fresh supply areas, basically. That's it. If you are asking how to discern it perfectly, the person that's asking this question has barely been trading for 2 months, so you have to just put in more work, put in more chart time, and you will start being able to discern more blocks. Ask yourself, why did this block work? Why didn't this one work? What was the thing in this one? Like for instance, now if someone goes ahead and says, "Oh, I had this order block marked out here, and let's do this. I had this order block marked out here, and then price came, took me out. Why didn't this order block work? I mean, this is a down candle. Here's a breaking structure. We are not in a bullish trend. These are the kind of things that actually mess people up. People will be picking bullish order blocks when actually price is heavily bearish. Now, if you remember what I just basically marked out here was a range high, and then here's a range low. So price was seeking this level. I took this trade. I think I took it. No, it's not on my Instagram, but I took it live. I was short on a Friday. I think it was on a Friday. I went short on this day. You went into a bearish OB. So if you were using this, while you were using this, I was using this. I was using the bearish order book because why price was bearish and I was looking for sells instead of buys. So those are the kind of things that affect people's, oh, my order block did not work for me. You were picking the wrong block in the wrong market condition. So that's it. The next question was let me try and remember. The person goes, that he did a risk allocation thing, opened a demo account of $10,000, was looking to lose what $100 per trade, um which is basically 1% of 10,000, but he got told that he should risk 50. There are two things involved. I have two spreadsheets. One is a spread bet account. The other one is for a retail broker account. You need to understand which one you are using, because if you are using a spread bet account and you were told to put in a lot size of 50 on a spread bet account, that basically means £50 per pip, right? Which is still wild, because that means you have to, oh, I'm not wrong, yeah, £50 a pip, which basically means you have to have a 2 pip stop loss before you lose $100, which I that would be a bit crazy anyways. But if you're using a retail broker account, 50 lot size would basically mean £500 per pip, which is 5 times of your risk. And you cannot use a 1 pip stop loss. So even if you're using a 2 pip stop, which is still a bit crazy, if you're using a 2 pip stop loss, that means you're risking 10% of your account per trade. So these are the kind of things that are important. Understand what leverage means. And then I think the person's question was which is still crazy, because I think the person's question was how that he tried putting on a 50 lot size, which I'm guessing is a retail broker, right? He tried putting on a 50 lot size, and he got told there's not enough money. So he was asking, is there a limit to the amount of lot size you can use on a trade? There's actually no limit, but then there's a limit depending on your leverage. You need to understand what leverages are. Go to Baby Pips. Since towards the ending of the whole school module thing on Baby Pips, it talks about leverages, pips, lot sizes, risk allocation, position sizing, which I go over. But then let me just quickly run over what leverage is. If you pick a broker and you open an account of 100 to 1 leverage, which is what I use, basically means you can open times 100 of whatever you have in your account. So let's say you've got $10,000 in your account. If you times that by 10, basically means you can open a lot size that's equivalent to having a 100,000, 1 million, basically a £1 million account or $1 million account, basically 1 million, whatever account. Now, the way brokers look at accounts is basically in units. So a 0.01 lot size is 1,000 units. 0.10 lot size, which is basically 0.1 lot size, which is a mini lot, is 10,000 units. And one standard lot size is 100,000 units. 10 lot size is basically 1 million units. So basically, if you open a 10 lot, which is a 10 standard lot, that's you're basically opening 1 million units. That would basically means you need to have equivalent of $1 million in your account, or a leverage that allows you to basically look like you've got $1 million in your account. So if you've got $10,000 in your account and you want to open a 50 lot size, you need to have a leverage of 500 to 1, or at least 800 to 1, or 1,000 to 1, which to me is crazy. You don't need those kind of leverages if you know what you're doing. All you need is a leverage of 100 to 1, 200 to 1 at most, if you understand how to manage your risk and then make the most out of it. But that's just it, and that's why you were being told that you could not open more. I also just go back to Baby Pips. And this is why I always tell everyone to read Baby Pips, because these are the kind of things I don't really like going over. I can't be bothered showing someone what leverages are. I expect you to know it. because it's really not hard. It's just basically studying. It shows character if you go to Gbpips and understand most of the things before you come in. Um, so yeah, go to Gbpips, go to the School of Pipsology. I think that's the name. It's quite a corny name. School of Pipsology, and then get your answers from there. Just basically look for where it talks about it. I think it's towards the last lesson, like the graduation service or something like that. Now, the last question, which I left it to be the last question, was probably the most important question in my opinion. Um, I have to find where I wrote down this question, so give me a minute. The person basically talks about struggling with finding things in real time, which I know some of you are going through that phase. But the person just joined the trade room, and this is what he sends to me. He goes, had a quick look through the content, and the titles are sort of the thing that I have learned or been learning. Of course, I'll watch them in order. But if I told you that I struggle to apply things in real time, whereas in hindsight, I can show the stop rate or rejection off of this key level, da 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 da. Where do you think I'm lacking? Is it a confidence issue? Am I not backtesting correctly? I really struggle sometimes in real time, but when I look back, I see the things have happened for this and this and this reason. I'll give you three answers that should help you if you follow them. Um, the first problem you're having is lack of confidence. That's definitely it for sure. Lack of confidence. Second thing is that you're focused on money. Third thing is you haven't put in enough work. Now, when I mean enough work, I'm not talking about you haven't studied your charts. Because if you're being honest with me here and saying that you have put in the work, you understand these things, but the problem is you cannot find it in real time, it sort of doesn't make sense to me. Because if you understand what it is and you kind of put it out there in real time, is basically that means you have done the theory aspect of it, but you haven't done the practical. Like even for me, for instance, I'm going into a new niche, I'm going into a new industry. Most of you know what I'm going into, but I'm going into a new industry, and I have done courses, paid for mentors, being mentored. And I had a meeting with someone on Saturday, and he was like, "Oh yeah, get this other stuff. It's like that. It's like £2,000, and da 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 da. It will really help you do da 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 da." In the niche that I'm in, I did not have an issue paying the money, but I just realized that all what I was doing was accumulating theory aspects of it, and I had not done one simple practical. Now, how do you do the practical in FX? Because I know, yeah, you're thinking, all right, yeah, I tried to do it, but it doesn't work. It's because one thing is that you're probably trading off of a live account. You're trying to make money off of that live account. You're trying to get your stats right off of that live account. I'm not going to mention the person's name, but you told me you came from a signal service. That just shows me that you're focused more on the money aspect of it. Now, quite all right. Each and every one of us in this game are in it for the money. Like, believe me, I wouldn't do it if there was no money in this industry. Each and every one of us were in it for the money. But you have to understand that the moment you desensitize yourself from the money, that's when the money comes. It sounds really, really stupid. It sounds really, really, really stupid. But the moment you desensitize yourself from the money, the moment you say, you know, fuck it, let me learn the craft properly and forget about the money aspect of it, that's when the money comes to you. Because you will not be scared of taking these trades on a demo account. So it shows me for you not to even take these trades, I'm definitely sure that you're trying to trade off of a live account. Your losses are probably not even positions, right? You take like a $20 loss. I don't know what your accounts are, but let me just for instance take a $20 loss. You feel that pain because you've lost money now. You're not sure of yourself, so you do not take the next trade. I will get stopped out 3 times and still take the next trade. Why? Is because I have gotten rid of that aspect. I was on a demo account for an annoying long time. That's where most of my confidence came from. Someone else in this trade room had the same issue. He's probably like one of my first students. And you guys, if he's watching this, he will not, and he knows himself. He had the same issue. He knew exactly what to do, could read the price chart, could mark out everything to an annoying sick level, right? But he couldn't get anything right. And I forced him to go on demo accounts, and that's where his confidence came back, and he has been killing it after he came back from the demo account. So one thing I will tell you is that if some people have an ego thing, which I think is quite stupid. Like, fuck your ego. No one market doesn't care about you. Some people have an ego thing where they say, you know what, I would never ever trade on a demo account. Demo is for pussies. Da, 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 da. Well, the one advice I can give to you is go on a live account, but risk probably 0.1%, 0.25%, 0. You risk the barest minimum that it doesn't affect your trading account. Say you've got a £5,000 account, trade with 0.01 lot sizes. Now, what that does is it lets you take the things that you see, because the thing is that you are actually seeing this in real time, but then you undo yourself because you do not trust yourself enough to take the trade. So you see an order block, you see a breaker, you see a market structure break, you see a fair value gap, you see things line up, and you say, you know what? Last time I did this, I lost money. So you know what? I will not take the trade. So you let it go. You come back and you realize that your trade had panned out for a 10 hour, and you're thinking, oh, I don't know how to trade. What's wrong with me? Things that you actually know what to do, but you're attached to the money aspect of it. So that fear of losing more money is on your mind. And the person that's talking to me hasn't been trading for, let's say, a long time. So I know this is a confidence issue and not a technical aspect issue. If you're being honest with me and you actually know these things, you actually know how to read the price chart, and you're not just trying to sound cool. If you're being honest with me, the best advice I'll give to you, and I beg you take it, is go back to a demo account. Take trades. Do not try to build a statistics for me. Do not try to build a stats for yourself. Do not try to build a MyFX book. Take trades and just see if you're right about it. That's just all what matters in this game. Do you even know what you're doing? That's what is really going to tell you if you know what you say you know. Because you cannot know. Is that when people say, oh, I can make $10,000 or based on my stats, and I say, based on what stats? Have you done it before? And the person goes, no. I'm like, yeah, I don't believe you. Right now, I can't say, oh yeah, I can take an account based on how I catch odds. I can take an account from 10,000 to 1,000,000 within a year. Oh yeah, I cannot really say that because I've never done it before. So you cannot tell me you really know what you know when you haven't actually practiced. So it's all theory. It's all I can, but you haven't done it yet. And the only way you can do it is actually doing it. So it's people think you get the confidence and then you know how to trade. No, you trade by getting you basically have to put yourself out there. It's like this saying when they say you put your cock on the block. Like you literally have to just put yourself out there, mash up the work, and get slapped and learn from it. And that's where the confidence comes from. You do not get the confidence and then come to learn how to trade. It doesn't happen that way. You learn you get your confidence while you're at work. That's why trading is probably one of the hardest things, because it's not like, oh, I read this book, I've watched this video, now I'm a trader, I'm a profitable trader, I've changed my life. That's not how it works. You have to get smacked. You have to put yourself out there, and you have to slightly be stubborn in a way that, I got smacked today, I'll come back tomorrow and I'll see what I can do right. As long as you learn from getting stopped out, getting your losses. So I would say go on a demo account or risk 0.1%, 0.05% if you can. Which basically is half of a tenth of a percent. Do that on your account. That's the way you build your confidence, because that way, when you get stopped out, there's literally no emotion attached to it, which is what trading should be like. You want to be desensitized from the money as much as you can. That's why you see some traders go, like the big traders, right? They go, I'm risking 0.5, 0.25%. You think, oh, that's so little. But mind you, these guys have got like a £2 million account. So if you go 1% of a 2 million, that's 20,000. They do not really want to be slapping 20,000 per trade, right? And getting stopped out. So what they do is they drop to a tenth of 20,000, which is $2,000 per trade. Or then they drop it to like half of a tenth of a percent, which is basically £1,000 per trade, which they're fine with. So they're fine losing £1,000 per trade. That way, they get good stats because they're not concerned about the money. But meanwhile, they're good enough to make that half of a tenth of a percent become something useful for a monthly return or a yearly return or quarterly return. So, what advice that I would really, 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 really give to you is, please go to a demo account, open a demo account. Do not really care about the stats for now. All what you want to see is if you're even getting the levels right. Because you say you've done your homework, you say you know these things. Now you have to go out there and put yourself out there. That's why trading is the way it is. That's why it's a difficult job, because you do not get the confidence before you come into the job. You learn while you are working and while you're getting slapped by the market and while you're getting stopped by the market and why you feel like throwing up. That's where the confidence comes from. That's where the resilience comes from. That's where you get stubborn enough to push yourself to where you start trusting yourself to take good trades. And all right, I know what I'm doing now. I'm a profitable trader now, and da 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 da. So that's what I would suggest. Go back to your demo account. This is literally the best advice I can give to you, and I hope you take it. Go back to your demo account or raise the barest minimum on your account. And I bet you will start seeing more better trades because this way you're not attached to the trades. I personally was on a demo account for probably up to 6 months. I will not try and bluff like, oh, I came on and I was slapping it. I was in a demo account for up to 6 months. Opened my first live account with like, I think it was $80, $100. I didn't have much. Opened my first demo account with that, and then slowly worked my way up from there. Went back to a demo account even after I opened my first live account because I realized it's not the same. A demo account is not the same as a live account. So I had to go back, build more confidence, came back, and then worked my way simply to where I am today, where you guys see me calling sick moves. You do not get the confidence before trading. Watching me talk is not going to give you confidence. Watching whoever talk is not going to give you confidence in trading. Trading is not some motivational stuff where you hear someone speak at a seminar and then you go back and you're smashing it. Is if you take the advice of if, that the person gives, yes, that will help you. So I would say go back to a demo account, take trades. Do not try to build a stat. Yes, take proper 1% risk trades, 0.5% risk trades, 2% risk trades at most, but do not try to go out there and see if you can. Just basically go out there, put yourself in that, see if you know what you say you know. If you've done your homework and you studied these things, go out there, put yourself out there, test it out. If you see price come to a key level, key off of a key level, take the trade. If you see a stop rate happen and it lines up, take the trade. The things that you're not taking enough trades on your live account because you're scared of losing more money, and that way you're not developing. But if you're on a demo account, you can take 25 trades a day. It doesn't matter. You would learn as you are on it to drop your lot size, to drop the pairs that you're trading. When I started, I was trading 28 pairs. I was trading, yeah, I was trading everything. I was trading every single thing: silver, gold, oil, whole 28 currencies, CHF, JPY. I was on it. But with time, I think there was a week I made like 1,000 pips in 2 weeks. But then when I had the loss, it got too much. I started realizing, all right, cool. I'm good enough now. Now I need to drop my pairs and become more professional because I really can't be taking such losses on a big account when I get a big account. So those are the kind of things I would say. I hope the Q&A was helpful. It was quite annoying doing this all over again. As I said, the first one I didn't get the my mic on. But that's it, guys. I hope you guys have a good week. The videos will be with you people by Thursday, I think. Nah, today's what? Today's Monday. Hopefully, I'll be able to get it out by Monday now.